Ever pondered over the current economic situation in Pakistan? It's a fascinating study indeed. To delve into it, one must understand the concept of the policy rate. This is a key tool used by the central bank to control inflation, manage economic growth, and maintain overall financial stability. The policy rate is the interest rate at which commercial banks borrow money from the central bank. When the policy rate increases, borrowing becomes more expensive, which in turn slows down investment and spending. Conversely, when the policy rate decreases, borrowing becomes cheaper, stimulating investment and spending. Recently, the State Bank of Pakistan, the country's central bank, kept its key policy rate unchanged at 22%. This decision was made to combat the persistent inflationary pressures and address broader pressures on the economy. Now, what does this mean for Pakistan's economy? Higher policy rates while tackling inflation can also slow down economic growth. However, the central bank expects inflation to drop towards the upper range of its 5 to 7% medium-term target by the end of fiscal 2024. To summarize, the policy rate is a critical tool used by central banks to control inflation and stimulate or slow down economic growth. In the case of Pakistan, the central bank has kept the rate unchanged at 22% to combat persistent inflation. While this might slow down economic growth in the short term, the bank expects inflation to drop towards its medium-term target by the end of fiscal 2024. In the grand scheme of things, understanding policy rates and their impacts can provide a clear picture of a country's economic health. For Pakistan, it appears to be a delicate balancing act between managing inflation and stimulating growth. As with any economic decision, only time will tell the full impact of this policy rate decision.